and I'm Kei Komuro, and I'm Kei Komuro, and I'm Kei Komuro, and I'm Kei Komuro, and I'm Kei Komuro.
Welcome to Startup Launchpad, the podcast that educates entrepreneurs about forming, growing, and protecting a startup. Startup Launchpad is produced by the Entrepreneurial Law Clinic at Fordham University School of Law in New York City. This podcast is for educational purposes only. It is not legal advice, and it's made possible by the generous support of the NASDAQ Educational Foundation and Fordham's Entrepreneurial Law Advisory Council.
Hello, everyone. I'm William DeWolf.
And I'm Kei Komuro, and you're listening to the Startup Launchpad.
Thank you for joining us today. We'll be covering one of the most exciting and complex aspects of entrepreneurship, private equity.
William and I are students from the Fordham University School of Law in New York City. We are participating in the law school's newest clinic, the Entrepreneurial Law Clinic, under the direction of Professor Barnes Grant.
In the Startup Launchpad, law students participating in the clinic will discuss topics of interest to entrepreneurs and aspiring entrepreneurs.
We hope you find this episode useful, and we encourage you to check out all the resources that the clinic can offer as you start and begin to grow your business. Today, we have a special guest who wants to share with us his special expertise in private equity.
We will start with a brief discussion about what private equity is and introduce you to the basic concepts of private equity and venture capital financing. Then we will delve deeper into the typical concerns that investors and entrepreneurs typically have in private equity financing. We're planning to cover several different topics today.
Our goal is to give you understanding how the private equity works and how to put yourself in the best position to attract investors and raise money for your business.
Our special guest today, Robert Nolan, is a Fordham Law alum and the managing partner of Halyard Capital, a private equity firm that focuses on high-growth sectors of the market, including tech. He is also a member of the Fordham Entrepreneurial Law Advisory Council. Mr. Nolan has been kind enough to volunteer his time to share his own experiences. Hi, Mr. Nolan. Thank you for coming on our podcast today. How are you doing?
Doing well, gentlemen, and thrilled to be here with you, too. So I look forward to sharing some thoughts with you and hopefully informing the audience appropriately.
Well, thank you. We all appreciate that. From law to private equity, it seems you've had quite a diverse career. Can you tell us more about your background, what you're doing now?
I'd be happy to. I graduated from Fordham Law School in 1977. I dare say in those days, the world of private equity was much different than it is today. I began my career as a securities attorney, focusing primarily on state and local government issuance for the first 3 years, and then transferred into the world of investment banking. My undergraduate degree had been in business. And with a legal background, honestly, it was quite helpful in making that transition for two obvious reasons. One, as it related to municipal securities, the distinction for the record between municipal and corporate law is that in municipal legal circles, in order to transact in any form, you need to be expressly or implicitly authorized by law to do so, either state constitution or legislative act. In corporate behavior, it's completely different. You actually can do most anything unless you're prohibited from doing so under the SEC guidelines, amongst others. So it actually affords you an interesting look at behaviorally how you go about fashioning the best practices for a given situation legally and financially. In any event, back to my career, I got into investment banking, and then in the year 2000 began a private equity firm known as Halyard Capital. We are a growth capital-oriented firm. Today, focused on technology-enabled service companies, which we will discuss. And most importantly, have done it for 20 years across a number of funds. 6 of those years, I actually managed a merchant banking portfolio for the Bank of Montreal, which involved buyout funds as well.
Yes, so you mentioned that your legal experience was helpful in transitioning from the world of law to the world of private equity. Can you talk more about that? What sort of legal training you got that you feel is useful to you now?
Well, first of all, as long as there's any semblance of contract law underpinning transactional behavior, legal background will always have a primary role. So the ability to read documents, to understand them, to have written them, to have drafted them, so that you understand both sides of every issue, which of course you're taught here at this fine institution, is critical to then being able to negotiate effectively the documents that underpin the transaction that you are engaged in. So I think it's enormously helpful.
Okay, it's very interesting. It is our understanding that a private equity fund is an investment fund that generally invests directly in companies and usually holds these investments for a number of years. So because of that, we suppose that investors who are interested in long-term profits tend to prefer private equity. In general, what is the typical spectrum of private capital investment? In other words, at what stage in the development do startups seek private equity investments?
Well, in answer to the question, the spectrum is broad.
Right.
And in terms of the stage in which they seek capital from private equity or venture capitalists, or as we'll talk in a minute, seed capital opportunities, it really depends on the business plan itself and their ability to both target a rational approach to a business and then convince an investor that their plan is worthy and that it meets the individual criteria that an investor may use. But let's step back and talk about the spectrum within the world of venture capital, private equity, and even before that, seed capital. Seed capital today, of course, has become much more formalized over the last, say, dozen years than it was previously. Today, you have pools of angel capital, which are individuals who come together with a similar purpose in mind and invest in entrepreneurial opportunities. There's also been the formation of crowdfunding, which you all are familiar with, that has allowed seed efforts to be funded for smaller dollars, but nonetheless is a way of democratizing the capital raise and making it available to a broader marketplace. And finally, there's such vehicles known as micro venture capitalists. Maybe some of you have heard of 500 Startups, which is again a portfolio of early stage opportunities that are funded differently because they're so early stage, so they're more like seed capital, and yet they butt up against the venture capital scenario. So first we have seed capital, which, as I said, has become more institutionalized than just individuals backing early stage companies. Second stage is venture capital. And at that point, you're probably, well, you should have an entrepreneur already a plan in place with respect to a marketplace, that you have a rational approach in which to penetrate that marketplace, and then you have a product or service that resonates with an investor. Venture capitalists, first and foremost, need a product service that they're going to reward with their own capital, and they also are going to look at ways in which they can enhance that product or service into a broader market. Normally, they look at the total addressable market size of an opportunity, and then they try and assess what the percentage penetration would be by this particularly new company in being able to penetrate that market. Now, today, there's much more focus on disruption of a marketplace as opposed to penetration. They are both fall into similar categories. The disruption can be an entirely new service, but you're still addressing the same total addressable market. One may take more education as a result of it being newly formatted to that customer. But the fact of the matter is that from a venture capitalist standpoint, much of the same analysis is done. The disruption usually emanates from a need to transform an industry or a sector or a product or a service, and hence this entrepreneurial opportunity provides that. So yes, disruption and penetration are two ways of getting at the same successful ending. I would say that the one other thing that venture capital focuses entirely is the ability to hire key talent. They want to make sure they have some access to that talent and in which they can aid and abet the cause of the entrepreneur. And we'll come back to talent because that underpins all successful ventures. Moving up the ladder, if you will, through the spectrum, growth capital is next. Growth capital is usually the expansion stage for a given opportunity. They're usually proceeds used to either further develop a product or service, maybe expand the sales force, maybe add additional offices, but all of it's focused on how best to grow at a more rapid rate, to scale your product or service to a broader audience, and ultimately to arrive at positive cash flow. The growth stage is one that that you see much capital formed around today from the private equity world because there's been so much money placed into early stage opportunities that growth capital is now has a much bigger pool of opportunity to choose from. Finally, the traditional private equity end, and that's the most mature end of the spectrum, is one in which you're dealing with companies that have already proven the model, the business model is being successful. They have proof of profitability, they have large revenues in place, and they tend to be companies that at that point are in a position where they can be bought out, oftentimes with leverage. So you know that means that there's cash flow that already exists in a business if you're able to place leverage on that balance sheet. So again, you're at the mature end of the marketplace with private equity. You may know it more as a take private end, take private end in that private equity comes in and buys a public concern or public company and takes it private by buying in the ownership from the public shareholders. Again, that's only going to happen in situations where you have a proven business model, proven plan, and a profitable scenario.
At what point in the stage is investor looking to sort of see a profit? I know things might have changed a bit in recent years with certain emerging, industries that are focused more on branding than, traditional profit lines. But at what point would an investor want to see a profit? Would this be at the venture stage? Would this be at the growth capital stage? What do you think?
It's a good question because it is a shifting bar. Venture capital, less so. I mean, they're happy to take profits if you have a profitable concern from a standing start, but they're much more interested in the size of the market, your ability to grow your share of that market, however you come about it. As we mentioned, disruption versus penetration. I would say on the growth capital side, you're much closer to it. You have to have proof of revenue, which again proves that the business model actually has an acceptance in the marketplace. And then as to profitability, there's always the trade-off at the growth stage of whether you want to grow at a more rapid pace and hence defer a profitable margin because the growth opportunity is so immediate and may be timely, meaning that there's enough competition forthcoming that you need to penetrate that market and grow it as quickly as you can, and the dollar should focus on revenue growth, not profitability. So I would say growth capital maybe in the later stages, certainly when you're at the private equity end, they would like to have it, particularly if they're thinking of a capital structure that would include leverage.
Okay, that sounds very interesting. Why startups choose private equity investments over other financing options, do you think?
Well, I think, and as I said, when we talk about private equity, let's put it in the umbrella sense of private equity, which includes venture capital, which includes seed capital formation. I think in that case, startups should be choosing that type of formed capital from those pools of capital that provide more than just the dollars themselves, meaning that they're accessing both experienced operators who may already exist within this venture capital fund, let alone a network of experienced operators or executives who can assist this startup in becoming a more fulsome and profitable business over time. I think that sometimes that gets underweighted. Sometimes there's a rush to have capital because of the needs of a given opportunity and the desire to get started and grow it as rapidly as possible. I do believe that an entrepreneur would be best served by looking at the nature of those who are furnishing the capital and making sure that they bring the skill sets that the entrepreneur may lack in-house at the outset, such that they're surrounded by appropriate operational skills, financial skills, sales or managerial skills that augment the entrepreneur's own team. And they're visible out there. And look, you're both familiar with the world of incubation. That's one way in which early stage entrepreneurs take advantage of it. They go into incubators, which actually will provide some of those services. And you all do it through your legal services, which is something that an entrepreneur needs from the formation stage, all helpful to them. So I would say there are many ways in which to do it. I don't think they always choose private equity or venture capital, but I think if they are, they should do so with an eye towards who they are actually, partnering with in a very value-add sense, meaning that they should insist on a value-added approach by that capital partner.
Throughout the duration of a private equity or venture capital investment, we anticipate that their investors could face a number of legal and practical issues, such as management issues and market changes. What kind of concerns do such funds and investors usually have?
Well, you've hit on a few of them, right? Always remember, the first and foremost rule with a venture capitalist or a private equity professional is that they believe management can deliver its promise. Now, that promise could be in the form of a product. It could be in the form of a service company. But the fact of the matter is it's usually based on an entrepreneur's vision and their perception of how they're going to make a difference in a marketplace. That being said, as an investor on the other side of that story, it's all about the actual accomplishment of their objectives. So the objectives have to be based in reality. They have to be formed financially appropriately, and that the growth has to be based on a scale that will make sense. I think some of the biggest problems that I see with early stage entrepreneurs is that they may have a very good idea. It may be an idea that has meaning and would have resonance in a marketplace, but they really haven't figured out the best way to deliver that product or service into the marketplace. Now, that may again require an outside influence that they don't have available to them. And that's why I suggest heavily that they seek more than capital when they talk to investors. They seek those that bring additional expertise that can assist them in their ability to penetrate or disrupt a marketplace.
Yep. Well, recently we've seen a trend of companies that are emerging in the market. Most of these are huge brands. Oftentimes they're social media companies that are they're very well known, but they're not really generating a profit. And this could be for many years. What kind of factors do private equity companies, venture capital funds use to evaluate such companies? How do you consider what makes this successful and what you are looking for?
Well, it's a good question. Again, this gets back to stage you're at within the spectrum of opportunity. Mm-hmm. Again, if you're an earlier stage investor, you're looking less at profit and more at the actual outcome that you think you can drive through that capital. More importantly, that you can assist the management team in driving to the outcome. Turning to the larger stage and more prominent companies that have raised enormous amounts of private capital and done so in a profitless business model to date, that is obviously a choice in which there's a belief that revenue at all costs is going to drive their initiatives at this point in time. And that subsequently they can impose price discipline, which will enable positive margin, which will obviously then result in profitability. That will happen over time if they have penetrated the market with enough depth, with enough meaning, with a substantial enough embedded customer base, a lot of obvious issues. So I don't think it's a hard and fast rule about profit, but I do think that profitless revenue growth is just that. It's an absolute phrase. People can drive profitless revenue. It's not that difficult. You can underprice a market, but you can't ultimately succeed if you haven't figured out a way in which to both penetrate that market on wide scale and then to impose a little discipline coming back. And we've seen, if you want examples, obviously take someone like Amazon. Amazon's e-commerce model has really never been a profitable model. It isn't designed to be. It was designed to penetrate the broadest possible universe, and then they would figure out a way to pull back and be more disciplined, if you will, in the pricing of their service. So they've done it through membership models, as you know, with Amazon Prime and other services. But where they really did it was an ancillary business, and we will talk about IP development at some point here, which was Amazon Web Services. Since they were doing it to handle their own commerce business, they then outsourced it to other startups and early stage software businesses in particular. And that business mushroomed. And they did sort of profitable arena because that business started almost from a profitable viewpoint of we're going to outsource service that we already do in-house. So we can do that with the cost already embedded in our arrangement in-house, and we're going to sell that service outside. So that had a generous profitability already associated with an Amazon Web Services now underpins a lot of the profitability at the overall Amazon effort. So, look, I don't think you need to be profitable day one, and clearly the market has told everyone this, but I do think you need to figure out a path ultimately, because ultimately you need to show a measure of success beyond just adding customers in a profitless manner.
So now, from entrepreneurs' perspective, we believe that entrepreneurs have several incentives to seek capital through private equity fund. Entrepreneurs usually spend substantial amount of time developing their services or products, and therefore they may need to raise a relatively substantial amount of capital to fund the service or product development from the long-term investors. What kind of concerns do entrepreneurs usually have? And what advice would you give them when they seek capital through private equity?
Well, we've touched on some of this, but let's talk about where an entrepreneur is in their own mindset when they approach an investor. First of all, it is their baby in every sense. They formed the idea, they formed the company, they have control over the situation, and now they're inviting in an outsider with a different perspective and maybe a bit different set of objectives. The first thing they should focus on is shared objective. That there's no doubt about it being a long-term objective for both parties. That they are investing in the management team and the business model as much as, a subsequent investment return. I'm a big believer in a shared approach from the outset, and that honestly penetrates through all levels of behavior between an investor and a management team or an entrepreneur, right down to how you share the profits, so that an investor will have his own mindset as to how he's repaid for his initial investment. But there are measures in which you can incentivize a management team to have a larger pool of the ultimate success if they perform at different levels of success. And I think inviting them in with incentives to be a bigger owner in the ultimate success of the company is something that most private equity funds will do and should do, so that there's a shared viewpoint from the start that it is going to be win-win in every sense. And a lot of that takes the investor stepping back and having reliance on the management team, both its vision and its execution, where the issues arise for entrepreneurs, of course, is that the vision never plays out exactly as they see it in their own minds. And that's a given in any business. Things happen. Competition comes from an angle you never perceived, or there's a disruption in the marketplace broadly that has impact on you. It doesn't even have to be secular to your own activity. The fact of the matter is that you need to be flexible enough, and you need to have an investment partner who's flexible enough to deal with the ups and downs or the myriad of different elements arising over time. So flexibility in the partner, very important, that they can handle both good times and bad. And I would lastly suggest that if you're going to have an early stage investor with you, you also ask them to keep some money available for a second round, such that you are at least assured that they're willing to devote more capital in the future to the further success and growth of the company.
So I think you mentioned a win-win relationship, but what kind of value-added benefits should an entrepreneur look for in a private equity fund?
And I touched on this a little earlier.
Right.
I think you look at your own organizational structure, you look at, as an entrepreneur, you look at your own framework, you look at the positions that are filled, the positions that are unfilled, and you look to an investor group to help fill some of those positions, even if they do it on a consultative basis as opposed to hiring a full-time employee. You may not be at the stage of full-time employment for every position in an organizational framework. But having said that, they should have access to talent that is required to help the entrepreneur realize its ambition, his or her. And I think that's something that can be easily assessed at the outset. The entrepreneur should have a pretty good sense of what their greatest needs are, and that could be sales, it could be marketing, it could be product development, it could be financial, it could be a number of things. And they should get that checklist in front of them when they meet with the individual investors and see where those investors can help them specifically, either out of their network of contacts or folks they employ directly who they can then outsource to the entrepreneur.
I mean, to some degree, and I try not to completely reiterate your point, it sounds like a lot of these investors, when they come in, they create an idea, they have sort of a vision of how this should be run. And in a way, a smart, effective investor will also help guide them, will help give them some sort of structure and help show the entrepreneur what they don't know and what they can add into the product to just make it a more effective product down the road. Is that correct?
It is. And let's just step back. If you're an investor and you're dealing with an entrepreneur and you like their idea, the fact of the matter is you shouldn't be that deeply involved to begin with. You should be invited in to a large degree in terms of your involvement. Because first of all, you like the individual, you like their idea, you like their approach to the market, and you should have up front with that entrepreneur a discussion on how that market is best accessed and how you could assist them in making sure they can reach customers effectively and both in reach and in cost. So I'm a believer that there should be total alignment between investor and entrepreneurial management team from the outset, and there should be nothing left unsaid regarding how they could help one another. And make sure there's not going to be encroachment where there shouldn't be. That's the biggest issue I would have as an entrepreneur, is that you don't need someone trying to operate your business. That is why you've been brought in to the arena with this venture capitalist or seed capitalist or even a private equity fund. They want your input. They want you to run this company. They're not operators. They want to move on to other investments. The less headache for them, the better. And the best thing an entrepreneur can do for its investor is be transparent. Be open with information. Tell them in advance if you see a problem coming. Investors are accustomed to dealing with issues. That's what their days are about. The best way you can handle that is to always over-inform. The more information you provide to an investor, the less impediment there'll ever be. And it's unfortunate at times entrepreneurs get a little bit self-possessive in terms of information. The best entrepreneurs share, and at that point, they have less involvement from the investor.
On a no-names basis, of course, are you able to tell us a war story from your career of this happening?
Oh, God. I'm sure I can recite a few war stories. As you well know, human nature is to always lead with good news and reserve the bad news. So this has happened a number of times, where the investor is informed about the bad news much too late to even be helpful, which is the worst thing that can happen. Look, as I said, there will be market stumbles. There will be operational hiccups. These are normal occurrences in day-to-day business. So why should any management team or any entrepreneur think that they're going to be treated differently in that regard? What they need to do is have that discussion up front with their investor. So yeah, there's no one war story I care to recite, but there are a number of them that led to very unnecessary discussions with management about why wasn't this addressed earlier. No one's clairvoyant, so we understand that there's not 100% clarity on all future activity from an entrepreneurial standpoint, but there is greater insight than the investor has because of the day-to-day involvement of management. And that's why I get back to the point of over-inform. Because if you see something on the horizon, I'd rather take this to a positive end, which is in a number of instances, we've had companies where the management team has said to us, look, we see competition coming from some large providers into this marketplace. They're going to have an impact on the price of our service, price of our product, and the ability for us to expand the way we'd like to a larger customer base. That type of information is critical to an investor, because at that point, then you might make plans about either capital raise to offset some of that competitive thrust, or start to think in terms about selling the company, if that's the right outcome as well, or a capital formation of some form. So I would say that I tend to look at information as a strategic input, and it's one that can't be shared enough between entrepreneur and investor.
So to bring this back in the direction of where our clinic is going, we understand that, especially in the past 5-10 years, there's been a greater push to social innovation and also public benefit in the marketplace, specifically private equity, venture capital, also generally. A lot of companies are starting to advertise themselves as benefit corporations, having a social mission attached to just profitability. Can you talk more about that?
Absolutely. I think it's a very positive development in the world of private equity, having been in it for 20 years and been around it for a lot longer than that. Let's go back in time again so that we understand how this has developed. Private equity years ago, and we'll go back 20, 30 years, was portrayed as a predatory arrangement, if you will. I hate to get into cliche-ridden territory, but even the Wall Street, you'll remember the original Wall Street movie, that was all about a buyout that ended up in a fight between union employees and the takeover bidder. Well, there was this constant portrayal of the notion that jobs were at risk if private equity came into a mature situation, because private equity's job was to drive more efficiency than had been exercised to date. The whole purpose of private equity was that they were not subject to quarterly concern, such as public companies are through their quarterly reporting. So as a result, they could take the longer-term view, and that often led to a different type of business model framework, some of which necessitated a transformation of the company, and oftentimes that resulted in job change. But, excuse me, so as a result, I would say that private equity wasn't always held in the highest esteem, broadly speaking. I think as looking at, again, at the spectrum, if you think of growth capital purveyors being one level before absolute buyout activity, growth capital thrives and lives on the basis of there being expansion of a product, service, but more importantly, growth in a business. Well, the only way that happens is with job creation. It can happen with IT technology benefit, so there are efficiencies that are forthcoming, but retraining of work staff, education of work staff, and greater employment, those should all be direct outgrowth of a smart growth capital plan. I know we always look at plans that are going to add headcount in the appropriate positions. And by the way, if the company's growing, you need that headcount anyway for customer contact, for possibly sales, marketing, et cetera. So I see it quite honestly as a very positive development because I think, number one, it allows private equity to get back to its real origin, which was to create jobs for growth. And those statistics are easily ascertained now and made available. Then we get to the point of a more diverse workforce, hugely overdue, glad that it's now being largely looked at, and will only benefit the companies themselves, let alone the investors, because of the fact that we need varied viewpoint at the table. It's the only way it ever succeeds. You need other viewpoints. And so having a diverse workforce, I think, is a must. It serves a social need, but it also has a reality steeped in better business practices. Governance is an area, we're talking environmental, social governance. Well, let me step back to environmental for a second. So on environmental, I think private equity as a group has moved in this direction. Now, whether they've been brought there kicking and screaming or whether they have voluntarily moved in that arena, there's been a very definitive movement, to obviously use alternative fuel sources, to obviously promote solar paneling where it's appropriate in business settings. But the whole move to a more green-based environment has honestly been a very positive development for private equity, just as it has been for society at large. I think in terms of governance, which is the third arm of ESG, that's still a work in progress. You will see one of the areas raised around the governance issue is, of course, the way in which the chairman and chief executive titles are oftentimes shared. In large companies here in the U.S., I think the numbers are something like 80% of U.S. companies have a shared title in the same resident in the same individual. Whereas in Europe, it's exactly the reverse. It's the flip side. The vast majority have separately titled individuals as chairman and as chief executive officer. Now, what does that really do? Well, theoretically, in a separate setting, an independent chairman at least will exercise more influence, and the board will be more influential theoretically with the chief executive officer. I think it's just good practice to have more thoughtful, experienced minds in a boardroom. So I'm all for the notion of sharing title. And by the way, it's a responsibility that the CEO really doesn't need. They're an executive for a reason. They don't need to be chairing a board meeting. That should be done by an outsider. They report throughout the board meeting, so it's not as if they don't have full involvement. They do. But I think it's much better done between two individuals. The other issues today that you hear on governance are the disparity between the average compensation between the employee base and the compensation of the senior management. I'm not one for putting an absolute range on what's proper and what's improper, but I would go back to how you share the wealth of success in a company. And I think all employees should be shareholders. I'm all for it. I think it should be made available to employees. And I think the amount of shares that they have should be representative of their efforts and their contributions to success. And I think we need to do a much better job of that. I think there should be. Most investors will want to see heavy shareholder involvement coming from the employee end, because then we know we're all totally aligned. And I'm not talking about just public shareholders. I'm talking about in a private company setting where you can make available equity throughout the ranks. And in fact, we insist on it with many of our investments, so that we know that there's total buy-in from the individual employees and that they know that we have a shared objective with them to maximize the value of that company, which will inure to their benefit.
You've been touching on this quite a bit in your explanation, but from just a narrow perspective, when you're looking at a company, how do you value the benefits and social mission?
Wow. Well, the balance or the benefits, because there's a balance between the two. Mm-hmm. I think I don't think they're contradictory, and I don't think they have to be at odds. I think they can be aligned. So the balance may be more easily achieved than we even recognize. But there may be a cost at the outset, which is where business sometimes stumbles. Because they may see some of these socially driven missions as being just costly and not providing benefit. And this gets back to a long-term perspective versus a short-term perspective. I think if you have a long-term perspective based on the reality of the way a company works best, we all know it works best from a strong culture. And that culture is best formed when you have buy-in from all parties. And that buy-in needs to have a shared involvement. And the shared involvement usually has to involve some form of equity ownership going throughout the ranks. But there also has to be accountability throughout the ranks. So you need a board that's going to hold its management team accountable on all levels, including social levels, so that diversity is properly achieved across employee base. And more importantly, that there's representation across all activities within a company that properly represent the company within a, let's say, in a suitable manner. There's so much in the press today about aberrant behavior in a business setting that a board has no choice but to enact governance that will ensure safety and appropriate behavior for all parties. So that's become much more public than it had been previously, and it's been a great idea and quite unfortunately an overdue one. But you're going to see more governance along those lines for sure.
Well, that seems to be the emergence of this new category called Certified B Corps, benefit corporations, and they're available as a corporate option in most states. What other sort of procedures can be taken, even if the company doesn't necessarily want to be a certified B Corp, but just wants to incorporate a social mission into its outlook?
Well, it can be a stated mission at the highest levels of the company, and it usually is today, particularly with startups. I mean, what was Google's great phrase at the beginning? Do no evil, or do you remember
that?
Something quite lofty. Yes, I think we'd all like to do no evil, or certainly most of us. I think that having a stated mission is always appropriate, Because again, you're looking for buy-in. How best can you do that? So you're going to do it across the culture of the company. But when we talk about whether it becomes the formation and the foundation for all activity within a company, that depends on the company itself. If the social mission is the foundation and is the primary purpose of that organization, then absolutely. Well, it can be as well stated and manifested across every wall and office in the company for all, if that's what it takes to remind them that that's the reason they're all gathered. But the reality is that it's usually a balance. It's usually some measured approach between having to do the day-to-day commerce of your given business and appropriate treatment of individuals with a broader mission involved. We all breathe this air. We ought to figure out a way to contribute to it being available to all in the most appropriate of manners. So I would just say to you, I don't think, mandated, yes, but it's got to come from the top. Cultures are a top-driven arrangement, unfortunately, because that's always a little bit needs to then have governance over the top of the house, and that's usually coming from the board if they're paying attention.
I'm going to put you on the spot here a little
Please.
bit. But is there one company or a couple companies that you particularly admire for accomplishing these goals?
Well, okay. I certainly think Apple gets a lot of credit for this. Now, they were a most unique company in that they had a product that resonated with the marketplace, and they have a great and loyal customer base. But that all comes from the fact that they focused on customer service. Do I think that all behavior within the four walls of Apple is perfect? I have no idea. But certainly to the outside world, they broadcast broad social missions, and they've and there's a second company I'm about to come to, and they've done a good job of focusing on the broader issues of life for both their employees and their customers. So I think in a business, it's a really tough business. I've owned consumer-focused electronic businesses, and trust me, it's hard because you're constantly iterating product to be the next level for a demanding customer base. So to be able to do that and be innovative and yet at the same time be humane, I think that's a winning hand. So I do have a lot of respect for the way in which they've done it. And look, I've read Steve Jobs' book. He wasn't a perfect human being either, but he left behind a pretty good representation of how to treat people. It's hard to do in a big organization. I don't, there. I'm sure many other companies I'm leaving out. They're just one that comes to mind.
How do you think this trend is going to evolve going forward? To my understanding, a lot of this has come from the customer base. People want to be purchasing products from more socially focused businesses. So how will this evolve going forward, in your opinion?
Well, two things. One is we touched on this a bit. There are pools of private capital that focus, as you know, on just the environmental, social, and governance arena. And within that, those are pools of capital who have their own mandates to invest in companies that are going to drive those initiatives. So you're focused on the social initiative. I think it's an incredibly healthy arrangement because I'm a big believer that you can do good and do well. And that's what this is saying. It's saying we can act appropriately across employment practice, behavioral practice, customer behavior. And there's a way in which we can lead rather than follow and still be profitable. So I think the fact that we have investors who are willing to set forth as their mandate that there's a dual mission. It's both to be successful as an investor, but not at the expense, but rather at the same level of reward for a social mission. And I'm a believer that we're going to see more of it. There's been capital contributed to that notion already today. We're going to see more of it in the future. So I'm actually encouraged by it. I think, but you're saying, what will it look like? Time will tell. Rather than guess at the actual arrangement, I would say more capital will be focused on it. And look, we talked a little bit before, their infrastructure is a primary area, which I think could actually be served a little bit by this pool of capital. There are many public-private partnerships that make sense for infrastructure-based activity. And I'd like to see some of the ESG money focused in that area since to date, we seem to have had a hard time getting just the federal government focused on it. So let's focus on other ways in which to do it in a more grassroots fashion. I think that will encourage, again, better social practices. And that will be across all types of activities, particularly an infrastructure project. So the encouragement of proper practice across every business setting, I think would be a really positive development, and I think it's forthcoming.
All right, so this concludes our interview. Thank you for joining our podcast and providing some great insights and some wonderful advice to entrepreneurs. We think that it will be helpful for educating our law students, entrepreneurs, and listeners interested in private equity. Are there any additional thoughts you would like to share today?
Well, the question that I get most often from students and then entrepreneurs is, you asked it in a different fashion. How does one get involved in private equity in the broadest sense? Well, today there's so many different ways in which to do this, and we touched on the democratization of private equity. When I came into it, you had to be an accredited investor under the SEC guidelines. Today you do in most formats, but there's also ways in which you can participate in a lesser format with lesser capital. So they've made it available to more parties, number one. Not at the risk of their capital, but more importantly, just that they have exposure to how this world operates. So I might mention, and I think it's high time, that we did away with the term private equity because it's a misnomer. There are many forms now of publicly available capital being associated with private equity. I'm a consultant to one such group. It's called Connecticut Innovations. It's a state-funded venture pool of capital that has a dual mission. It invests in early-stage opportunities, obviously with seeking an investment return from the capital, but at the same time encouraging commerce to locate in the state of Connecticut. Now, most states have this, or a number of them have it, I should say. So it's not a novel idea, but it helps encourage the state. The state capital obviously is dependent upon its own citizenry. So there's another form in which they benefit from private equity investments. Thankfully, in that case, the private equity investments have done well. So I merely mention them as one example of a dual mission formed capital group. But and I know there are all types of angel groups that come from different foundations. There are many educational institutions, Fordham included, that has a group of angel investors that are now institutionalizing so they can be helpful to the community of Fordham-based entrepreneurs or those with some affiliation with the arena. I think it's a very positive development. It spreads the whole notion of it no longer being private equity practiced by only a few and benefited in only by a few, but rather practiced by many and benefiting many, which gets back to the social mission sitting alongside the profit-driven success objective.
Well, this is sort of coming back to a point that we've sort of been touching on throughout this whole interview, is that entrepreneurship generally is more available to more people. It is something that somebody can pursue at the age of 18, at the age of 30, at the age of 40. They can switch industries. It's becoming something that is able to be achieved by anyone. So having access to these opportunities and considering a wide range of opportunities, it's really important for anyone who is sitting down and thinking, okay, I have this great idea, but how do I want to pursue it?
I agree. And look, that's the beauty of today's world, is that you have audiences available to entrepreneurs with good ideas. We talked about the different incubation vehicles that are out there. And there are many in New York, as we've talked about in the past. I think that's great. I mean, it's an opportunity for a good idea to be rewarded and to be surrounded by a framework of organization and skill sets and resources that enable it to grow properly, both nurture it and develop and then grow appropriately. In the old days, it was much more cut and dried. They probably didn't have access. The entrepreneur with a good idea really had to bang their head against the wall for a long time before they were able to actually break through and find someone who was willing to invest in them because of the private nature of it. Remember, these are illiquid investments. Let's not kid ourselves. This isn't the stock market. It isn't something you sell day to day. But having said that, the entrepreneur now has an opportunity through these various pools of capital to almost have the kind of liquidity that was in the old days afforded to earlier stage opportunities only through a public setting, public stock market. So I am highly encouraged. I wish I was their age again, because I think the opportunity to have a dream developed and nurtured is the greatest reward one can have in the business world. So I agree with you. And the nice thing is you have large institutions that are validating this type of capital pool every day, be it educational institutions, be it foundations, be it family offices, be it state-funded pools of capital, be it municipally funded pools of capital. They want to help, and they know that it leads to direct commerce benefit, meaning job creation. And one of the most attractive elements for an investor is the potential, let alone the realization, of intellectual property that is derived from the business idea being touted by the individual entrepreneur. Intellectual property is interesting because oftentimes it's developed as an outgrowth of the business itself. It's not identified up front, but oftentimes is one that comes as a result of it. You'll hear much accorded these days to data and the need for better data and distilled data and data science. Well, there's no doubt that data is important. I'm not a big fan of the phrase big data because I think that's merely confusing. It's all about the perfect data, believe me, and we've owned data-driven marketing businesses. It is, but nonetheless, the advent of IP in most product or service businesses comes from, these days, usually some access to specific data that may not exist elsewhere, behaviorally induced possibly by a customer base. I think I've been in two businesses where we ended up selling intellectual property that was formed as an outgrowth of the core business. So in one case, years ago, we owned a marketing services company, and they did what was then known as electronic couponing. And we ended up selling that to a very large merchandiser who wanted it for their own arena. And quite honestly, it just fell out of the fact that we were exposing that area to other customers as one more service available to them as a marketing service company, and we ended up selling it in its own right as an asset. We've done that in a few instances. We own a company that facilitates Workday software for enterprise customers. And we ended up with what became a proprietary way in which to integrate that software into an enterprise arena. And that became very important to Workday itself, and they ended up buying that particular software tweak that we made to their own integration. So it was sort of interesting, and again, it was being rewarded for, quite honestly, product development, but sort of ancillary product development to making sure the customer was properly benefited. So all I would suggest is that as an entrepreneur, you're going to have your core mission and always be aware that an investor such as you should be, look at the intellectual property that's both being formed by your direct service and then maybe some offshoots from that property and how it might be used in other settings. Because that's the beauty of intellectual property. It gives to more than just the immediate audience. It gives to other audiences in forms that probably weren't contemplated at the point of inception. And we've seen it benefit the investor as well as the entrepreneur.
I promised Mr. Nolan I wouldn't do this, but to the listeners, if there's one takeaway from this, the opportunities are out there. Just be sure to do your research. You can find what you're looking for, but do the research, be thorough, and the opportunities will present themselves. So I'd like to thank Mr. Nolan for being here today. Thank you so much for joining us. We really enjoyed having you on the podcast. And to our listeners, we hope you now have a better understanding of private equity and the venture capital market, as well as when entrepreneurs should consider venture capital or private equity financing. I'd like to thank all our listeners for joining us today. And again, our thanks to Mr. Nolan for being here.
Thank you, gentlemen. It was a pleasure.
Thanks for joining us on this episode of Startup Launchpad. If you enjoyed it, please don't forget to subscribe to our podcast and leave a rating and review. For more information, check out our show notes at startuplaunchpad.org and follow us on Twitter at FordhamELC. We'll be releasing a new episode every other week, so stay tuned.